Hello, everyone, and welcome to today's self-directed IRAs and 401ks 101, presented at the CamaPlan office weekly, live in Ambler. Today, we're going to go over the basics of self-direction for people just getting started or have yet to start with self-direction. A lot of good information in today's presentation. My name is William Mucker. I'm a client executive with CamaPlan. Before we get started, we do have a brief disclosure to go through. Here at CamaPlan, we're a neutral third-party administrator of IRAs. We are not attorneys, financial advisors, CPAs, or tax professionals. So if you ever need advice in any one of those fields, we highly recommend that you talk to your team of professionals. If you would like us to be a part of that dialogue with your team of professionals, we're more than happy to join in on that conversation to make sure the investment process is quick and seamless. And we do not sell any investments at CamaPlan, nor do we endorse any products. So we will never call you about the next best investment opportunity. We always believe you should do your own due diligence, whether it be your personal funds or retirement funds. With that said, let's get started. Here's a little brief summary of what we'll go through today. Understanding self-directed IRAs, the different type of investments you can make, the different types of accounts, how the process works, and a little bit of tax considerations and resources and where we got all of this information. So first things first, what is a self-directed IRA? So self-directed is just an adjective. If you go to Schwab or Fidelity or TD Ameritrade or any other brokerage, they might tell you have a self-directed IRA. But what they mean by that is you can invest your IRA into any one of these investments, and they'll point to a list of investments that they'll sell you. With a true self-directed IRA, there is no list. You pick the investment that's right for you. You follow the prohibited transaction guidelines that we'll go over here in just a little bit. And then we'll help you facilitate that transaction into that investment, keep record of that investment and the transactions, and then report to the IRS at the end of every year. Here's a quote by one of our clients: investing in what you know, understand, and control versus using hope as a strategy. Now, most investors come to us to diversify their retirement portfolio and use what they're using currently with their personal funds to invest their retirement funds in there, that they know they're going to be able to grow their retirement plan much faster than they are currently on the stock market, where they have no control over what a company does or how it performs. So these are tangible assets. Here are some accounts that can be self-directed. Again, self-directed is just an adjective. The accounts you actually open up with us will still be traditional IRAs, Roth IRAs, SEP IRAs, simple IRAs. We do HSAs, ESAs. All the same rules apply. The only thing that differs is the investments that you're making and how we facilitate them. Excuse me. So you have your tax-deferred side. You have your traditional IRA. You have your SEP IRA, simple IRA, which are linked to employers. Then you have your 401k plans, defined benefit plans, defined contribution plans. And then to note, the spousal IRAs, they also apply to the tax-free account. Spousal just means that if you have a non-working spouse, and you have a working spouse that is contributing to a traditional or Roth IRA. So the tax-deferred accounts, the income you put into that as a contribution is not taxed, or should I say, the contributions you make from your ordinary income are not taxed. And then years down the line, when you take a distribution, the contributions and the earnings you made over that time will be taxable. Then you have your tax-free accounts. There are post-tax accounts like the Roth IRA, which came around in, I think it was the Tax Relief Act of 1997. It's named after the Senator William Roth who proposed the idea. The idea behind that is the income, your W-2 income or your earnings that you put into the Roth IRA via contribution is taxable. And then years down the line, when you're eligible to take a qualified distribution, those distributions are tax-free. So the way we like to say it is, you're paying taxes on the seed rather than the crop, which we'll go over a visual that'll help you better grasp that and how useful that is. More tax-free accounts, the health savings account, the HSA. The health savings account is only one of its type where the contributions are tax-deferred, just like the tax-deferred accounts, and the distributions are eligible to be tax-free if for a qualified medical expense. Then you have your educational savings account, and then another component of the 401ks, the Roth components, that are also allowable. Here's some differences between a 401k and a self-directed IRA. The main differences are the investments that that you can make. You can invest into life insurance with a solo 401k. However, you can't invest directly into life insurance policies with an IRA. You can take loans against solo 401ks, $50,000 or 50% of the account balance, whichever is less. And then for solo 401ks, UDFI does not apply. We'll go over UDFI towards the end of the presentation. That stands for unrelated debt financed income. So $100,000 of income, what do you get to keep? $100 of earnings, what do you get to keep? Through 4 different avenues of investing. So you invest your time into a W-2 job. Your salary pays you $100,000, and then you're paying 40% in taxes. As an example, federal, state, local, Medicare, Social Security. So you're paying 40% of taxes in this tax bracket. So you only walk away with $60,000, and $40,000 goes to Uncle Sam to help him keep the lights on. Then you have your passive income, your rent, royalties, dividends. You invest that, you earn $100,000 back. You only get to keep $75,000 because you get a little bit of leeway with the passive income, but you're still paying a 25% tax in this current bracket. So you walk away with $75,000. Then you have the tax sheltered accounts, these IRAs, the tax deferred accounts I mentioned earlier, and the tax-free accounts like the Roth, where you earn $100,000, and while it's in the account, that's $100,000 not taxed. Now there is an asterisk next to the tax deferred accounts. That means you're going to have to pay taxes on that $100,000 when you take a distribution. Now with a Roth IRA, that $100,000 at distribution for a qualified distribution is tax-free in your pocket. No taxes paid because you already paid the taxes on the contribution. Here's another example, another visual of that last slide. So $50,000 over 40 years at a 10% rate of return and a 30% tax bracket. What do you get to walk away with? So the blue is your W-2 salary that you invested. The light green is your tax deferred investment. And the dark green is your tax-free accounts like the Roth IRA. Now you see over 40 years, you only walk away with $700,000 with your W-2 salary that you invested because you're paying taxes on all the income that you earn over that time. It doesn't compound, and then you're earning less. It's important to note with the tax-deferred account and the tax-free account like the Roth IRAs, they both earn $2.2 million. However, when you go to take a distribution from the tax-deferred account of that $2.2 million, you end up paying $700,000 in taxes, where the Roth IRA, it's $2.2 million tax-free in your pocket. So we're a little bit partial to the Roths. Here are the different types of investments you can make out of self-directed IRA. These are some examples, but you're not limited to. The biggest things that we see people invest into at CamaPlan are purchasing physical property, where the IRA is the owner of a property. They rent it out. We'll go into more specifics. It doesn't just have to be a rental, but we'll go into that. Lending money, privately traded companies that aren't listed on the stock market. For example, before Apple went public, you could buy shares of a private placement from them. And you can do that here at CamaPlan through a self-directed IRA. Precious metals, there are some rules with that, but some people buy and hold precious metals in their IRAs. And then there's the others. So we've seen people purchase livestock. We've seen people purchase trees and sell the fruit. People do cryptocurrencies. There are a number of different options. You just got to make sure you're following the prohibited transactions guidelines that we'll go over. So a little bit more about real estate. A little bit more of a deep dive into that. Real estate that you purchase out of the IRA, it can be single family, it could be commercial, it could be a plot of land, it could be a buy and hold, it could be a rent. Some people flip. However, there are some rules with that we'll talk about when we get to the tax implications later on. But basically in this example, the way it works is the IRA is a separate entity from you, similar to a trust. So like I said, my name's William Mucker. If I wanted to purchase an property out of my IRA, William Mucker wouldn't be the purchaser of that property. It would be CamaPlan FBO, which stands for benefit of William Mucker IRA. That would be the owner of the property. I would initial the agreement and send that into CamaPlan. They'd sign on the agreement as the third-party administrator of the IRA and then send the funds from my IRA to closing. and then that property would show up into my IRA as an asset, similar to if I were to purchase a stock at Schwab or something like that. So like I said, some people rent it out, some people do buy and hold, some people flip, some people develop on undeveloped land, buy plots of land and sit on it. It really depends. So the options are really vast with a self-directed IRA. Here we have private lending. So if you want to make a note, lend it to somebody from your IRA. Same thing as to purchasing property. The lender on that note is not you, it's the IRA. Again, it's a separate entity similar to a trust. You can secure it via a mortgage. You can do unsecured notes. Obviously, don't risk it. Secure it to a property or secure it to something. Trust deeds, convertible notes, where notes can convert from the terms into equity into a company, shares of a company, and discounted notes. So you can buy notes on the secondary market. You don't have to originate the note out of the IRA. So another asset class popular amongst CamaPlan and self-directed IRA investors. Then I gave an example earlier when I went over private placements. So this is before a company goes public. You can purchase shares of their company via a private placement. They'll most likely have something called a subscription agreement. And then the subscriber on that subscription agreement, you guessed it, is the IRA, not you personally. Initially, let's send it into CamaPlan with the other supporting documents, and then we'll send the money over to the company for the purchase of those shares. Here are some examples: joint ventures, structured settlements, investment clubs, hedge funds. Those are some of the examples of private placements. And then another option for diversification is precious metals. So a future slide, it'll say that you can't purchase metals out of an IRA, but there are exceptions for precious metals. You got gold, silver, palladium, platinum. And then there are other things like precious metals composite, which is a composite of a number of different types of metals that you can own in your IRA. The exception that's made for these metals is that they have to be a certain percentage pure. They have to be produced by a manufacturer that is licensed. And then they have to be new. They have to be a certain quality. And you can hold those in your IRA as an investment, just like if you were to purchase them personally, just with a few different rules that we'll go over in just a moment. So what can you not invest to? What are the prohibited investments when it comes to investing out of an IRA? And this isn't just self-directed IRAs. Like I said, all those same rules apply to a self-directed IRA that apply elsewhere. So any collectibles and life insurance, except for the life insurance part doesn't apply to the solo 401ks or the 401ks. But collectibles and life insurance are prohibited in an IRA. These are hard to value assets. You can go to a gallery and look at a painting that's basically just a brush stroke. You might say it's $5. Somebody else might say it's $500,000. So they're hard to value assets, and they're trying to prevent you from getting money into an IRA apart from standard investments and contributions. And then at the bottom you can see there's an exception for certain metals, U.S. government gold or silver eagle, gold and palladium bullion. So another thing that can make a transaction prohibited by the IRS that you make out of your IRA is sweat equity and self-dealing. So I believe the next slide will go over prohibited persons, but when you're investing out of your IRA, again, not just a self-directed IRA, it has to be an arm's length transaction strictly for investment purposes. So if your IRA were to purchase a property, you can pick the color of the paint, but you can't go in there with a paintbrush and paint the walls. If your IRA owns a property, you can't live in that property. You can't receive a direct benefit to the IRA nor provide a direct benefit to the IRA and its investments. Again, strictly for investment purposes and to grow your retirement account. Now, like I said, these are other disqualified persons other than you as the account holder. So this is mainly people of lineal, ascent, or descent of you, including your spouse, and any entity that those people in blue own 50% or more of or have managing control over. So these people in blue and those entities cannot receive a direct benefit from the IRA and its investments, nor provide a direct benefit to the IRA and its investments. So your IRA can't purchase a property and then rent it out to your son or your daughter. They can't rent it out to your spouse or your parents. and your children and your spouses or their companies cannot work on the property. The IRA has to pay somebody a competitive price that's going to be doing the work on the property. You're not paying taxes on the income you earn with that investment. So they want you to go out and pay somebody who's going to charge a competitive price that will be paying taxes on the income they earn from that work. Now, it's important to note that the people in green are not disqualified. So the blue are disqualified, lineal, ascent, or descent, but lateral relationships are not prohibited. So aunts, uncles, cousins, brothers, sisters, siblings, nieces, nephews, and your spouse's parents, they are all okay to receive a benefit from the IRA and its investments or provide one as well. So you can hire your brother to work on your IRA's property, or your IRA can hire your brother to work on the property it owns. All right, what does the process look like? From a CamaPlan perspective, this is what happens throughout the investment. So the first step is to open the account of CamaPlan. You can do it online, takes about 15 minutes. If you're transferring it in from if you're bringing money from a traditional or tax-deferred account, you want a traditional or tax-deferred account at CamaPlan. Then you'll fund the account. If it's coming from another IRA and it's going into an IRA CamaPlan, it'll be a transfer. We'll request that on your behalf. If it's coming from an employer plan, it'll be a rollover. That's something that you will need to initiate with your plan administrator. You just need to let us know that it's on the way so we can do proper record keeping of that transaction and code it correctly. You can also make contributions to the account in CamaPlan. Again, it's just like any other IRA you'll open. All the same rules apply. It's just different investments that you can make out of the CamaPlan IRA or self-directed IRA. Then you choose the investment that's right for you. If it's real estate that you're interested in, you'll choose real estate. If it's in private lending, you'll choose private lending. Precious metals, you'll choose precious metals. And then you'll get the supporting documentation for the investment. Send that in the CamaPlan. We process everything on our end within business days of receiving paperwork in good order. And then we'll release the funds to the investment based off your instructions on that paperwork. And then you deposit the profits. You earn the rent. It goes back into the IRA. You earn interest or dividend interest from a note. It goes back into the IRA. Interest or principal goes back into the IRA. And then you can just rinse and repeat. So it's pretty simple, pretty quick. On average, I tell people to expect from the date they open the account to the date they make their first investment to expect roughly 3 weeks. I did say we process everything on our end within 2 business days of receiving paperwork in good order. However, the biggest chunk of that time and the biggest variable is the funding process, because whereas we'll process everything within 2 business days of receiving paperwork in good order, every other custodian, every plan administrator has their own processing timelines. It depends on how the funds are getting sent. It depends if the account's liquidated or not. If they need to liquidate and move it into cash, that has to settle first, and then they have to send it. So there are a number of variables that go into it. Now, what does CamaPlan do? Why do you need us? So the IRS requires that you have a third party do record keeping of the transactions within the IRA, just like you need Schwab to have an IRA and invest in publicly traded assets. We're held by the same rules. We're a neutral third party. We facilitate the transactions, keep record of the transactions, and report to the IRS at the end of every year. We're a part of your core team of professionals. Like I said in the very beginning, we're not tax professionals, CPAs, financial advisors, or attorneys. So if you need advice in any one of those fields, contact your team of professionals that are eligible to give that advice. And if you want to include us into that conversation, we're more than happy to make sure we follow the guidance of your team of professionals. Here are some commonly asked questions. We went over the timeline to open and fund an account. We went over the different types of funding for an IRA at CamaPlan. Depending on the asset that you're choosing to CamaPlan will determine what type of supporting paperwork that'll go with it. For example, almost every one of our investments you'll submit a CamaPlan asset purchase directive. That's a direction of investment form, tells us what you're investing in, how much you're investing, where we're sending it, and how you'd like it sent. And then there's different supporting paperwork that goes with each investment. So if you're purchasing a property, it'll have an agreement of sale. If you're lending money, there'll be a promissory note and security paperwork, potentially, if you're securing it. A private placement will need the subscription agreement. filled out properly, where the IRA is a subscriber. We'll need an operating agreement and articles of formation for that company. And then, yeah, it'll vary depending on the actual asset, but you'll call us, you'll ask us the questions, and we'll make sure that you know exactly what to expect to have to submit for that investment before you make that investment. So who signs the paperwork when you invest, or your IRA invests, should I say? CamaPlan, for most investments, will sign on behalf of the IRA as third-party administrator for the IRA. You, as the account holder, will initial next to the signature line for those for the IRA. That lets us know that you're read and approved of the agreement, and gives us, along with the asset purchase directive, gives us the go-ahead to sign on behalf of the IRA for your account. The only asset that's different in that situation is private lending, because the promissory note between the IRA and the borrower is more so an agreement of terms between you and the borrower. So in that situation, you would sign on behalf of the IRA, and the asset purchase is our go-ahead with the promissory note to release those funds to that borrower. So that's the only little variation for the signatories on the or the signers on the investment paperwork. Can I use my IRA for the down payment of a property I want to own personally? No, you cannot. So the IRA is an investor. So if you want to use your IRA to invest into a property, the IRA has to own a percentage of that property, and whatever percentage it owns of that property is the percentage of all expenses it can pay for that investment. So down payment, purchase price, utility bills, renovations, whatever percentage it owns of the property is the percentage of those expenses it has to pay. And then whatever percentage it owns is a percentage of a return it's entitled to and is required to be paid back into the IRA from that investment. So, if you own a property 50% personally and 50% with your IRA, then 50% of the down payment has to come from the IRA, 50% of the purchase price has to come from the IRA, 50% of the renovation expenses have to come from the IRA, and 50% of all other expenses have to come from the IRA, like utility bills. And then, 50% of all return, like rental income and the eventual sale of the property, would have to go back to the IRA as well. Now, in that example, I just let you know that you can partner with your IRA. It's important to note, even if the IRA only owns 1% of the property, you still have to follow those prohibited transaction guidelines to their full extent. So if your IRA owns 1% of the property, you still can't live in the property, you still can't work on the property, and those prohibited people or disqualified persons I mentioned earlier cannot live in the property or work on the property. Can my IRA receive a loan to purchase a property? That is allowable, but it has to be through what's called a non-recourse loan. For those of you who do not know what a non-recourse loan is, that's a loan with different terms. It basically means if the IRA were to default on a payment for that mortgage or that loan, the only recourse the lender has is to go after the property itself, usually, or whatever is in that specific IRA the loan was made to. It can't go into your personal holdings, and it can't go into your other IRAs. Even if you have another IRA CamaPlan, it can't go into that. It can only go into after the IRA that specifically made the loan to that. It specifically made the loan to. And another reason why you have to use a non-recourse loan is because the loan isn't being made to you personally. It's being made to the IRA, which is a separate entity. You can personally guarantee that loan. So usually with these non-recourse loans, the requirements are much greater than your traditional financing. Another thing to note: if you're getting financing for a property that you're purchasing out of the IRA, then usually IRAs are tax sheltered accounts, but in some instances they do pay taxes. We'll go over that, I believe, in the next slide. The taxes that you'll have to pay if you get financing for property owned by the IRA is called UDFI, or unrelated debt finance income. Now, the specifics of how that's calculated, I don't know. Like I said, I'm not a tax professional. Nobody at CamaPlan is. So you'll have to talk to your CPA or accountant or tax professional about how that's calculated. They'll fill out a Form 990T and send that into CamaPlan. We'll review it, assign it, and send the funds from the IRA to the IRS to pay those taxes. Can I manage the property my IRA owns? So manage is a little bit of a hard to define term. Now, you can, like I said earlier, you can pick the color of the paint, you can pick the tenants, You can pick the utility provider you want to manage the property. You can pick who works on the property that's not a disqualified person. You just can't go in there yourself and do any of the work. There's no sweat equity allowed with investments held by your IRA. That's important to know if you're looking to get into real estate specifically, but it also applies to other investments as well. What do I do when there is a capital call? So some of those private placements that I mentioned earlier, they're set up to have called capital, where you'll sign up for a specific amount that you're going to be investing. However, it's not due immediately. It's called over time, depending on how it's structured. If there's a capital call for an investment like that, you'll just log into your online portal after the investment's been made and you submitted the initial paperwork. And then when the capital call comes around, you'll submit a payment request with a copy of the capital call. Tell us how to send it and where we're sending. And those usually get processed within 1 business day. And then you just pay us however you choose to send the funds. So $10 for a check or ACH, or $30 for a wire. And we'll send that over to the company for that capital call. Here we're talking about the tax considerations. We touched on it a little bit earlier, and in the last slide specifically. IRAs usually don't pay taxes, but in some instances they do. The 2 instances that you may come across, not very common, but do happen, are UBTI or UBIT, unrelated business income tax, and UDFI, or unrelated debt financed income. Now, we talked about UDFI. Now, on the other hand, there's UBIT, unrelated business income tax. This is the IRS. This is if the IRS thinks that you're running a business out of your IRA. What I've seen trigger it most commonly is if you're flipping properties in the IRA. Now, what the IRS's definition of a flip, they'll never say. Some people say if you hold a property for a year, it's okay. Some people say if you only sell this many times a year, then it's okay. But those people are not the IRS. And like I said, the IRS probably won't ever say. So it's important that if you come across something that you believe may be considered a flip, it's important to talk to your tax professional. Another thing that may trigger UBIT is if you're developing on undeveloped land, or that'll definitely trigger UBIT, should I say. So if you purchase a property of a plot of land, and then you want to build on it, or you want your IRA to build on it, then that would trigger the UBIT tax. If either of these taxes are triggered, you work with your tax professional, like I said. They'll file the Form 990T and send that into us so we can pay those taxes out of the funds that you have in your IRA. Here is a list of all the publications, the IRS publications and forms that you see that 990T down there on where we got all of this information to prove we're not just making this up and pulling it out of thin air. If you ever have trouble sleeping at night, keep these by your bedside. I'm sure these will help you get some shut-eye pretty quickly. Here's my contact information. If anybody here or watching this in the future have any questions about what was discussed in the presentation, want to have a free consultation about what they're trying to do out of their IRA, see how it works, please feel free to contact me at the email address or call us. I'll be happy to talk to anybody about self-direction. We really like to educate people as much as we can when it comes to self-direction. The biggest bridge that we need to cross is the education portion of it. I think it's only 3% of America knows and utilizes self-direction, and we're trying to change that. So that's everything. Again, if you have any questions, please feel free to talk to me. I'm more than happy to help. I want to thank everybody who came here personally, in person to our live event, or who's watching this recording online. Thank you for your time, and I hope to be hearing from you.